Hello and welcome. I'm Mimansa Verma, and you're watching BQ Prime. We have RBI monetary policy today. We had RBI monetary policy today where the RBI kept its repo rate unchanged. It was more or less in line with what the market had expected, but there are certain nuances due to which the Indian bond market reacted. And we have Mr. Mahendra Jajoo, CIO of Fixed Income at Mirae Asset Investment Managers, joining us here to tell us more about what is expected in the market and what leads to this volatility in the Indian bonds. Hello, sir. So the Indian bond
Hello.
yields had risen to 7.35, which is around 12 to 15 basis points from the last close. So what is it that is driving the Indian bonds market right now? Because of late we have seen a lot of activity, a lot of volatility in the market. So what is it today that has led to such a spike in yields?
So as you mentioned at the beginning that the Reserve Bank kept the policy rates unchanged. However, there was one little announcement about the possibility of the open market operations on the sales side, which means the Reserve Bank could potentially consider selling government bonds to the market in case they need to manage the liquidity and if the global environment becomes a little more adverse. And I think that is what has affected the bond prices today. In anticipation of the additional supply from the Reserve Bank, the market has reacted on the lines that you said, where the bond yields have gone up. You will recall that prior to the policy, the global bond yields had gone up significantly. In the last 2 weeks, the 10-year yield in US has gone up by about 60 basis points to close to 4.75, which is almost a 15-year high. However, our bond yields had not reacted because the market was expecting a little bit more dovish guidance from the Reserve Bank, which has not been the case. So there is also an element of little bit of catching up with the global yields at this point. So I think combination of the indications of a possibility of the open market sales as well as the catching up with the global yields is leading to the reaction in the market today.
Okay. Okay. Sir, if you could just elaborate this for our viewers, that how much of, because RBI governor said that the spike in bond yields, our bond yields, is not related to external factors and it is not linked to the US bond yields shooting up. So if you could just explain it for our viewers, that how strong is the linkage between US bond yields and Indian bond yields, and if not, then just what is the way ahead that is going to be for India?
So see, but there is a short-term time frame and there is a longer-term time frame. India is a large economy today. We are the fifth largest economy in the world, and we are a major participant in the global trade environment. We are one of the largest importer of oil, crude oil, and we are one of the largest exporter of the IT services. Therefore, what happens in the global market is bound to have impact on India. We also run a large current account deficit, and therefore we need large capital flows every year to balance our account on the capital side. And therefore, I think in the long run, the domestic policy has to be in sync with the global policy. It does not have to be exactly the same. For example, right now, as the governor rightly said, that today's increase in the bond yields is not related to the global environment. What I mentioned also was that today the RBI gave an indication of a possible open market sales to manage the liquidity, the durable liquidity, and that had led to this reaction in the market. However, in the prelude to the policy today, there has been a sharp rise in the government bond yields across the globe, and that may have also led to the decision from the Reserve Bank in terms of initiating this guidance about the open market sale. So the things are not linked one-on-one, things are not linked on a day-to-day basis. What I meant to say is that directionally, the things have to move in the same direction to the extent there is a common interest and overlapping of interest between India and the global economy. However, India has its own domestic strength. We have a large forex reserve. we have a very moderate inflation, we have a very proactive central bank which has guided us so nicely through the COVID disruption and then through the geopolitical disruption caused by the conflict between Russia and Ukraine. So therefore, our central bank has demonstrated in the last couple of years that there is no one-to-one correlation. But at the same time, at the macro level, there is a certain amount of synchronization with the global policy. So that distinction has to be borne in mind in the context of understanding the governance domain.
Okay, fair enough, sir. Sir, if you could give a level that the traders and the market should watch out for, because there should be, it's a 15 basis point hike today. It's the largest single day jump since August last year. So what is the level that we should watch out for in the coming months or coming days? 7.35 is what I believe the current bond yields are at.
Yeah, so generally, I think when a big, event takes place, it is not very wise to start taking such an early preemptive call as to where it will stop, because we have to see how the market is positioned, how much unwinding happens, what is the extent of the open market sales that the Reserve Bank does, whether the securities that are being offered in the open market operations are short dated or long dated. So there are a lot of factors which will go into deciding. So ideally, as I said, it is too early to take a call as to where it will stop. But just from a pure reference point, last year when the situation was very difficult, there were a lot of uncertainties. Fed had just started hiking rates. We saw the 10-year yield peak at 7.60. And in the last 1 year, I think it happened sometimes around the same time last year, about 12 months back. In the last 12 months, we have not seen that level again. And there was one occasion in March, I think, when the 10-year yield just about hit close to 7.5, but then it retraced back. So I would say that somewhere between 7.5 to 7.60 is a very strong resistance that we should observe. And that's where possibly we can review whether the levels are going to go higher from here or settle there and find some support in terms of the buying by the investors.
Okay. Sir, coming to the JP Morgan bond inclusion, we had seen a lot of volatility there as well. Bond yields had come down, but it again started rising. It was not, the market reaction was not as big as people were expecting. A part of it is also because JP Morgan bond inclusion has been in the conversation for a long time, so it must have been factored in as well. But what is the dynamic in the market right now? What are people talking about? What is the way ahead? Because we have our borrowing calendar released already. So what is the way ahead for the Indian bond markets?
So if you look at the inclusion of the bonds in the JP Morgan index on a standalone basis, it's an extremely positive development for India, because obviously there will be a lot of FPI flows on the debt side over a period of time. And then it's not just only JP Morgan, but going forward, we would like to believe that even the bigger indices players like Bloomberg and Barclays will also actively consider including the Indian government bonds into their respective indices. Also, there is a certain amount of risk aversion as far as Russia and China are concerned. So there is a lot of vacuum which has to be filled up, and India is the best country to fill up that vacuum. And therefore, I believe that that will also expedite the inclusion of the Indian government bonds into those indices. But even if you look at JP Morgan index, the first instance of the bond flow will happen maybe in June, July 2024, which is 9 to 10 months away. And then over a period of time, it will happen slowly over a period of 10 months. Therefore, while that is very positive, the immediate action in the market is also governed and guided by the overshadowing events. So the global crude prices going up in the last 2 weeks and then correcting, or the global bond is touching the highest since the global financial crisis, or the impact it might have on the India's current account deficit and the capital flows. If the equity markets show some kind of turbulence, those are the immediate factors that then overtake that use. And therefore, I think we have to distinguish again between a long-term positive on the margin and the immediate factors. So that's where I think that in spite of that such a positive development, we have seen the bond yields go up because of the immediate factors which concern the market.
Okay. Okay. Thank you so much, sir, for taking out time to be with us here today. Thank you so much. Yeah.
Thank you. My pleasure. Thank you.